percentage ownership cannot.
Also, the other 33%, they
No.
cannot do a
No.
1031.
No, it has to be controlling interest, they can do a 1031 exchange.
Oh.
So then that would have to be restructured, and then it'd have to have enough time for like a taxation year to restructure
Okay.
it, and then you could possibly do that sale with, and do a 1031 exchange. So that person that's in that position of 67% is the only one that's entitled to do a 1031 exchange. Well, not the only one. If he decides, or that entity decides to do it, then the other entities can do it as well. But
So if the 67 does it, then they kind of pull
Right.
along the 33, basically,
right, but the 33 cannot do it without the 67.
without the 67.
Yeah, so that would be a restructuring issue that you would have to look at doing for sure.
Okay.
Yeah. And I have an example of that here. So that, basically this is what I was referring to before, is a drop and swap and drop, or swap and drop. So, and I said this here in the first line, is that very, very risky in California, because when you're paying capital gains tax, you're not just paying a federal capital gains tax, you're paying state capital gains tax, and you're paying recapture of depreciation. So do you guys know what the breakdown is on that, right? I'll give you a real quick recap. So the federal is anywhere from 15% to 20% depending on your tax bracket, federally capital gains tax. Then you have the 3.8 that we covered earlier with the Affordable Health Care Act. And then you have whatever your state capital gains tax is. And here in Arizona it's about 5%. Okay? And then your depreciation, if you own that property and been depreciating it or not depreciating it, doesn't matter. But if you own the property for more than a couple years and you have depreciated the property or the dwelling on the property, whatever you depreciated that for is what the IRS wants to recapture 25% of that. So if you depreciated $10,000 of your property in 1 year, they're going to want $2,500 back if you sell and don't do a 1031 exchange. So that's what your tax obligation is going to be. But if you're going to do that in California, what they're saying, changing your LLC and structuring that 67% to be more 51, and then the other one 49%, and that's possible to do that, but the one that has an exchange, that's what they call a drop and swap. So you're basically dropping the taxpayer and swapping the percent of ownership so that you can acquire something to defer your taxes. The IRS does not want you to do that. They want you to follow along. They feel like you're trying to avoid paying capital gains by doing something like that. So unless there's enough aging or seasoning time, then they will allow you to do it. Now in the state of California, I would never do it, a drop and swap, unless it's at least a year plus anytime you change anything in ownership. So it has at least one taxation year that you did the change and percentage of ownership, and now they're paying their taxes based on that and so on. Then you want to sell, then it's okay. But, go ahead.
I'm sorry, before we move too far
Yeah.
past it, on the depreciation recapture, don't you pay effective tax rates, not capital gains on that?
It's 25% of what the actual amount was.
So it's not effective, it's just 25%.
It's flat 25%.
Okay.
And the kicker I was alluding to is that if you have not claimed your depreciation on your taxes, you thought you would outsmart the IRS and say, hey, I'm not going to take depreciation. That way there's no way they can recapture it. They will take 25% of what you should have depreciated the property for. So always take your depreciation on your properties because they're going to recapture regardless. Okay? And again, if you do a 1031 exchange, you can defer it all to a new property. You don't have to pay it. Okay? Okay, so don't do drop and swaps, changing any of the ownership in California unless you do enough seasoning time or taxation time. And then this is just saying here that the last 1031 they may have done was years ago, and basically talking about the same thing I was talking about there. That's just the form 1065 that you would have to admit doing that if you get into that situation. So we're not going to talk about negative stuff. Purchase interest of retiring partnerships. Now, these are things that come up again that we're just talking about. A partner who wishes to exchange and add equity which is used to buy out retiring partner. Once this occurs, the partnership performs an exchange, but you want to again make sure that there's enough time frame in there and that the replacement property is greater than the relinquished property. Okay, so like kind, going back to the basics, the relinquished property, that's the property that you own. So like kind could be any investment property that you want to purchase. But the main ingredient is that whatever that net sales price is of that relinquished property, say it's $200,000, you have to purchase a property replacement property of 200,000 less closing costs, so we'll say it's 180 or greater. So that's what it classifies as far as being a replacement property. So in this case here, when they're doing purchasing out your retiring partner, it's the same, whatever his equity, or we're using your example, 67 and 33. If you're purchasing out that 33%, you want to make sure that it's higher or greater than what if you're using your exchange funds, that it's higher or greater than what your value is that you're exchanging into. So that would be not necessarily your example of 100%, it'd be somebody that wants to buy out that 33%. Maybe you're getting a new partner that wants to go forward and do an exchange. So whoever buys that one using exchange funds has to make sure that the numbers are greater, or the same or greater.
Does that mean that the 67% person could buy out the 33% person? Does the 33% person then are able to go forward in an
There's going to be a
exchange?
buyout on that, but it has to match dollars on that. So 67% is actually greater than that 33%.
Yeah.
So he's going to have to give up some of his shares that equal that. So maybe not a portion of it that he sells off to have the funds, or he brings in money from outside to acquire that, and then he doesn't have to deal with anything as far as greater or less. He's just buying and investing in a property. But if he uses any of his own shares to buy it, they have to be that or greater of what he's acquiring. Does that sound confusing? It does. It sounds confusing for me even saying it, but it's basically that if you have 67% and he wants to sell off or liquidate that 67% of equity and get a loan on it, which is going to reduce his interest of that 67%. So now it's worth, let's say it was worth, I don't know the numbers that you have, but we'll say it's worth $1 million. But he liquidates it now, it's only worth $500,000, so that he could buy that 33%. That it has to be, that 33% has to be $500,000 or greater, or he'll have to pay tax on the difference. Okay, so that's real round numbers, and it never happens, but that's kind of makes a little more sense.
Yeah,
Anyway.
yeah.
All right, I'm not a tax advisor, here's my disclaimer, I'm not a CPA. We can just give you guidance. These things have to be structured and done through your tax advisor or your real estate attorney to get that. We can help with that. We have in-house attorneys, and we can help you direct you in the right way, even your counsel, your CPA, to make sure that everything is in compliance with the IRS. But that's the gist of it. Okay, any questions on that? Let's see if we can get to a topic that, this PowerPoint is about 2 hours, so I'm kind of going through some things that are more related to the time frame that we have. How much time do we have actually, Scott? About
1 till 1.
Okay, so we go 15 minutes. So I'm scooting through some things, not just because I want to get to that, but I want to get to stuff that's going to be more relative to what you guys are doing. So this is this is going to be a good one actually. So this is an installment sale combined with a 1031 exchange. Okay, so this happens because we get a lot of seller carrybacks in properties, right? Or they're going to carry back the portion of the note. Or you might be, as a seller, doing that as well. So how does that affect? Well, here's an example. So you got a sales price of $500,000, $100,000 down, and then a $400,000 note. Okay, that's pretty straightforward numbers. So the taxpayer becomes a beneficiary on the note. They have converted the real estate into cash, and it's no longer like kind with real estate. So basically what they're saying there is that now they sold off their interest, but it's only, that's at $400,000, but they don't have the actual real estate anymore now, okay? So then the value of the note and the 1031, the qualified intermediary must become the beneficiary at the close for the property, or choose one of the 3 options. So with that, now that he's changed it from a real piece of property to like almost to a stock or to a value, he could sell that note, he can replace the property, seller takes the note on, or the exchanger acts as the lender. All 3 of those things could be handled and done properly, but all he's doing there is now, when he goes down the line to sell this property, that $400,000 note is not, he can't exchange into real property for $400,000. He could only go into another note, unless he decides to sell that note and then now brings it back up to the $500,000, and then he could exchange to another $500,000. Or he could do another replacement property and take another note, or he can exchange and act as a lender. The third one is probably the one that I would recommend to go with, because then you're the lender to your own property. So if you have the funds for that $400,000 and you need it to invest in something else, just come up with a note to qualify for that. It could be ABC LLC is incorporated that's actually holding that property, and now you're becoming the lender on it, but you still have 100% interest in ownership of the property, so when you exchange down the line it makes it a lot easier. Does that sound? Everybody got that part? Okay. Alright. How many of you guys want to kind of go over like some of the basics of a delayed exchange? Yeah, the forward exchange, the normal exchange. A lot of this stuff is really complicated that we're getting into, and I kind of went over this at the last minute of having a conversation so we can cover some of the more sophisticated stuff when it comes to exchanges. But if you guys, some of the basics, this stuff gets really complicated. So I'm kind of putting the cart before the horse, I think, a little bit on some of it. I can tell by the way you guys are looking at it. But having a conversation with Linda, that's where we're kind of go. But some of the basics on 1031 exchange, okay? So I'll keep this up, but we'll keep going a little bit forward. That I come across a lot within the investor world is I'm getting a lot of calls from investors out of California and Colorado. Those are like the two states that I'm getting a lot of investors from, and Texas now too, starting to come in a little bit. They want to invest in our market mainly because they see some growth still here, where some of their states that they're in may plateaued, may look like it might go down in some examples there. Like Colorado, my counterpart up there is a little concerned that things may go down a little bit because it's so high up on real estate values. I don't know if you guys bought or purchased any properties in Colorado, but it's kind of hard to find replacement properties. They list it and it's sold pretty quickly. So they're looking for the replacement properties. So with the basic 1031 exchange, we call it delayed or forward exchange. The things that you need to know about it is that the timelines. You want to have an exchange set up prior to close of escrow. So what that means by setting it up is I just need a copy of the contract of that relinquished property, the property that you're selling. We can set it up. There's no cost to set up an exchange. That just sets up the clock, okay, or sets up that you're going to be in compliance with the IRS. The actual clock, the timeline, is 180 days I was speaking of earlier, but it doesn't start until the close of escrow. So we have a property, a rental property selling, and it's closing on December 1st. The clock starts on December 1st. You got 45 days on December 1st to identify. There's 3 ways to identify. There's a 3-property rule, which is literally 3 properties, and we don't care what the market value is of those. So that's the most popular because you can identify anything and everything. We just need an address, but you're limited to just 3 properties. The second one is the 200% rule, which is basically you sold $1 million property, you can identify up to $2 million of properties. So now you have to be conscientious of what the property value is because you're capped on the dollar amount, up to $2 million. It's 2 times whatever the sales price is. So it could be $200,000 sale, it'd be $400,000 you can identify. So you can put more than just 3 properties in on that 200% rule. Now there's another one, and it's more of an exception than as a rule, because if you go over the 3-property rule and you go over the 200% rule, what you have now is the 95% exclusion, which basically means that nuts and bolts of it is if you got 6 properties that you identified and it's over the 200% rule and it's obviously over the 3-property rule, you got to buy 95% of that value of those properties. Basically, you got to buy 100% of that. Unless you get an investor that gives you 5% in partnership interest in it. But you have to own almost 100% of what you identified if you go over those 2 rules. Now, as a qualified intermediary company, we will let you know when you're identifying that, hey, you're over this rule, you're over this rule. You may want to revoke that or this because you're going to be caught in this. So we're going to guide you through that process, but to know that basics. The timeline on the December 1st, you have 45 days to do that identification period. Now, in a hot market, you may want to not just throw us addresses that you're interested in, you may want to have a conversation with that seller because you identify it and a week later it could be gone. A lot of investors, what they're doing now is that they're identifying the property, at least throwing an offer at it and then getting a feel back from the seller that you may get an accepted offer. So then you can identify that you know you're on the right track, that this is the property that's going to happen, and let us know that one. And some people will come back to me on that identification period and say, well, I got 1 property, I'm 100% sure I want to go with it, and I'm only going to identify 1 and don't exercise property number 2 and number 3. Not a good choice, because what happens in real estate a lot?
It falls through. That
Right.
would be my question.
Right, so identify the backups. That's
Right.
where the property 2 and 3 come in. So you have a kind of an idea with those 45 days which one you want to buy. Then go and find that's one similar in the same neighborhood or same cost It may not even have any conversation with that seller, but at least throw that one in there, and then throw another one in there just in case.
So the 45 day is a hard day.
It's
You
a hard
have to
day.
identify the property. I understand you have until 180 days to make it
Yes.
all happen.
Yes.
But if you don't identify that property in the 45 days and it falls out, and now you're past the 45 days,
You can't read
that's it. You
That's
can't,
it.
you
Yeah.
can't identify more property.
No,
Okay.
it's whatever's in that 45 days. That's your concrete number. Whatever's in there is all you can exchange into.
Okay.
So you want to be fairly focused that one of those properties is going to be the ones you're going to purchase. The only way you can get more than 45 days. So we got that December 1st is when you're closing your property, right? But you know that you have a pretty solid offer. It's closing December 1st. We're at November 3rd right now. So what's stopping you from going out looking for replacement properties as soon as you got your deal set and closed? I mean, it's probably a pretty solid deal. It's going to close on the 3rd. So go out and start looking for your replacement properties now. You can put offers before the 45 days even starts. And then when you get to that timeline of 45 days, you're not going to be so stressed out on finding identification properties because you already did your homework up front and you may put offers in. So any monies that you put down on earnest money on properties before the 45 days starts, you'll get, your exchange can credit you back those funds. As long as you don't take ownership, you're still going to be okay for 1031 exchange. So then you got that December 1st close of escrow. You got 180 days from that 1st of December to close on whatever you that you identified, or all three of them, or two of the three, whatever you identify is what you can purchase. Most people on the West Coast don't hang on for the 180 days. On average, it's about 90 days. They're pretty much bought and sold. On the East Coast, for some reason, they hang on to it a little longer. It's almost closer to the 100-day mark. But transactions, if any of you have lived on the East Coast or done transactions on the East Coast, those 100 days, reason why is because they're the way they buy and sell properties are different than they do here on the West Coast. They don't use escrow officers, they use attorneys. And right, and title searches take a little longer because some of the properties are older and established more. So their due diligence process is longer than it is on the West Coast. So most people, you have that 180 days, that's plenty of time on the West Coast to buy and sell. But the biggest one is that 45 days, and I get that asked all the time. Can we go a little longer? There is some accommodators out there that like to accommodate. We're an unregulated industry as far as accommodators go. If you're working with an accommodator that will allow you to add other properties into that identification after the 45 days midnight, you're the one that's on the hook and risk, not that accommodator that is accommodating. So there is some companies out there that will say you could do it after 45 days. But you're the one that's on the hook for that if it ever gets audited and it's actually a felony. So you don't want to do that. But
You can do it, just go to jail.
you just go to jail, and
Try
I
to stop a
hope
lot of people.
exactly. And I hope you look good in orange because that's going to be your color. So yeah, and so then, like I said, like kind. This is the other one that comes up. That's a big issue. Is like kind is whatever the net sales price is of the relinquished property, the selling property. So if it's $200,000, what you can deduct from that is if you had to do some work on it prior to selling it. So you might have had to do some improvements that cost you $5,000, $10,000. You can reduce that if it's like within the time frame prior to sale. If you bought it and you hung on it for 2 years and you did work on it 2 years ago, that doesn't count. If it's stuff that you did just before posting it on the MLS, you can count those. You can count commissions, real estate commissions, and closing costs. So we'll say that's $20,000 on that $200,000 transaction. Now you have net sales price of $180,000. You have to find another property of $180,000 or greater to be 100% deferred, that you don't have to pay any of your capital gains into the new property. Now I get this question all the time. It's like, well, I put $30,000 down initially when I bought it, and I'm not getting taxed on that, so I want to pull that $30,000 back out again, and I want to buy a house instead of for $180,000, I want to buy it for $150,000. Is that going to be okay? Will I be taxed? Yeah, you might be taxed on that if you buy it at $150,000, because the 1031 exchange is like kind. You have to carry everything forward, which means if you have a mortgage on it, you have to carry it forward, and if you have your equity, you have to carry that forward, and whatever your net sales price, you have to carry that forward. If any one of those components is not there, what the difference is what they call boots. So you could be taxed on that difference. In that example of $30,000, you could be taxed on. It's a taxable amount. It's up to you and your accountant to decide on what you have to pay, or you have to pay anything on it at all. So be clear on that up front. I always advise to talk to your tax advisor just before the sale so you know what you're doing on that respect. The other thing that comes up is that you may want to buy a property and not carry the mortgage to the new property. You can do that, kind of like my example that we were talking about earlier here. The more sophisticated side is that if you have the funds that are outside of the sale, like say that there was a mortgage on the property for that $200,000 or $50,000, and you don't want to go get another $50,000 mortgage from another conventional lender. You can become the lender yourself if you have $50,000 in another account or another company that's outside of that transaction. You can create a note and you can be your own lender for that $50,000 on that property. So that way there you're carrying you're carrying the debt, so you're not going to be taxed on it, and you're putting that $50,000 that you already have from another source, another entity of your other property or whatever it is, and then you just create a note. Now you're the lender on your own property for that $50,000. You just pay yourself interest on that particular funds. So you can. There's other ways around that are completely legit. We just consult your tax advisor or your qualified intermediary on that. So then on the topic back to reverse and built to suit, just to kind of sum it up to make it a little bit more easier to understand. Is reverse exchange. The simplest thing about a reverse exchange is that you find a property that you're in love with and you have to have it. Main ingredient is that you have the funds to buy it before you sell your current property. So if it's a $300,000 property, you need to have it. It's a duplex somewhere that's in a hot market, you know it's a good property. If you have that $300,000, or you have a lender that can give you that $300,000, then you may want to look at doing a reverse. You're going to acquire that under the EAT, under the qualified intermediary. We'll hold it under that EAT until 180 days until you sell your property that you currently own to exchange into the one you just acquired. So relinquish into your replacement property you just acquired. So everything's reverse. You just have the 180 days. And a lot of times on reverse exchanges, 180 days is necessary. Just the opposite of a normal exchange. The built to suit, we kind of tucked on that, the more complicated side, but again, just summarize that simply. The built to suit is that if you have an exchange, you're selling it for $500,000, you want to buy a piece of land and you want to put more properties on it, or a duplex and another single family. You can buy the land, say it's $200,000, but now you got $300,000 left over, and that's what you're going to use to develop those that property and build on it. That $300,000 goes into an EAT, which is through a qualified intermediary. We're going to hold that and give you 180 days to use all those funds to build and develop that property. And we'll give you the withdrawals on the project as it goes, and as you did, similar to a construction loan. Now, if you go over the 180 days and there's say $50,000 left in that account, that would be called boots, and then that may be taxable. So you want to make sure that you use all your funds for the development. Now, don't be trying to outbeat the IRS and say that I'm just going to have a contractor and pay him an advance for doing services not a rendered. That will still be boot, because you can't just pay him that $50,000 for him to do work that hasn't been completed. So you want to make sure that all the completion is done with the funds prior to the 180 days. If you pay the contractor in advance, it's just going to be taxable income. We're right about at our time frame here. I know I kind of went all over the board as far as some really advanced stuff in the beginning. I hope I didn't lose you too much, but I summarized a little bit as far as what those are. And maybe next time I'll get with Linda and get more focus in on what you guys want to hear as far as the exchanges go. But anybody have any questions before we close out? Yeah.
Real quick, I guess, just from an administrative viewpoint.
Yeah.
What is your fee structure? What do we got to do to pay somebody like you to do what you do?
A lot of money.
Yeah.
No. You'll be surprised on how much we actually don't. We don't charge a lot of money. It's very similar to what title fees are. Okay. And what's the average title fee that you're paying these days? $700, $800, $900, right?
Yeah.
The exchange pricing for doing a normal or delayed exchange is about $750 to $950 flat. That will cover your relinquished property for one replacement property, and then $250 for every additional property that you replace.
Oh.
So that's pretty reasonable. On the reverse side, in built to suit that we were discussing, more expensive for obvious reasons. There's a lot more moving components there. Or there's an LLC that we're creating. We're holding title to a property that is for eventually your ownership. So there's liability issues that we're holding that property with. So they start residential at $5,000 and up depending on the exchange. And on the commercial side, the multi-million dollars, they're anywhere from $7,500 and up for reverse exchange or build to suit. So you've got to really like that property that you want to buy before you sell your property, or it has to be cost justified to cover for the reverse exchange. Good question. Any others? I think we're good. All right. Thank you guys for having me.
Yep, thank you.